Most people think turning $11,000 into $42 million is impossible. They assume it requires insider connections, decades of experience, or access to secret Wall Street algorithms. But what if I told you that one man did exactly that in less than 2 years, working from his home office in Los Angeles, using nothing but publicly available information, and an approach so simple it's almost insulting to modern finance? The story I'm about to share with you challenges everything Wall Street wants you to believe about trading. It's about a former pool contractor who cracked the code that professional fund managers spend millions trying to replicate. And here's the kicker. His method was built on principles that have existed for over a century, patterns that every trader can see but most completely ignore. Before I tell you how a pool contractor turned $11,000 into $42 million in 18 months, I need to ask you something brutal. How many blown accounts do you have hiding in your trading history? If that number makes you uncomfortable, you're exactly who needs to hear this story. Subscribe right now and hit that bell, because I'm about to expose the one psychological shift that separates the 1% who get obscenely rich from the 99% who keep funding their accounts. This isn't some fairy tale about getting lucky in a bull market. This is the story of Dan Zanger, and his achievement remains one of the most documented and audited trading records in financial history. Over 164,000% returns in 18 months. But before you think this is just another get-rich-quick story, understand this. What Zanger discovered about market psychology is so threatening to the traditional investment industry that they'd rather you never learn about it. The psychology behind his success exposes a fundamental truth that Wall Street desperately wants to keep hidden, that the market isn't this complex, unpredictable beast that requires advanced degrees and sophisticated models to understand. It's actually a visual language that speaks in patterns, and once you learn to read that language, opportunities for explosive growth become crystal clear. Most traders fail because they approach the market like a casino. They gamble on hunches, chase hot tips, and treat every trade like a lottery ticket. But Zanger understood something different. He realized that successful trading isn't about predicting the future. It's about recognizing the present with absolute clarity. It's about seeing what the smart money is doing before everyone else catches on. The traditional investment world teaches you to buy and hold, to diversify, to be patient, and to accept modest returns. They want you to believe that consistent profits require years of education and access to exclusive research. But Zanger proved that wrong. He showed that with the right psychological framework, a regular person could outperform the most prestigious hedge funds on the planet. What makes his story even more remarkable is that he didn't start as some Wall Street prodigy. For years, he was building luxury swimming pools for the wealthy residents of Beverly Hills. His introduction to trading was almost accidental, sparked by watching financial television in the late 70s. Like most beginners, his early attempts were disasters. He lost money consistently, trying different approaches without any real understanding of what he was doing. But here's where the psychology becomes fascinating. Instead of giving up like 99% of failed traders do, Zanger used those early losses as fuel. He realized that to succeed, he couldn't treat trading as a hobby or a side hustle. It had to become an obsession. This decision triggered what can only be described as one of the most intense periods of self-education in trading history. For over 20 years, Zanger dedicated himself to mastering one specific skill: reading chart patterns. He understood that he couldn't compete with Wall Street analysts on fundamental research. He didn't have access to company executives or insider information. But charts were the great equalizer. Every trader, from the biggest hedge fund to the smallest retail account, had access to the same price and volume data. This is where his psychology separated him from everyone else. While other traders were jumping from strategy to strategy, looking for the next hot tip or secret formula, Zanger was burning chart patterns into his subconscious mind. He would spend countless hours every night and every weekend studying thousands of historical stock charts. He wasn't casually browsing them. He was analyzing them with the intensity of a scientist searching for repeating patterns. He studied the market's greatest winners from decades past, meticulously examining their chart formations before they made massive price moves. This obsessive process was his version of medical training. He was learning to diagnose the health of a stock just by looking at its price action, the same way a doctor learns to read X-rays or MRI scans. Through this exhaustive research, Zanger developed a core belief that became the foundation of his entire approach. He believed that all fundamental information, all news, all hopes and fears, everything that could possibly affect the stock's price was immediately reflected in its chart. The chart was the final truth. It was the footprint of institutional money flow. This psychological shift is crucial to understand. Most traders get caught up in trying to predict what will happen next. They analyze earnings reports, read news articles, and follow analyst recommendations. But Zanger realized that by the time information becomes public, it's already too late. The smart money has already acted. The chart shows you what's happening right now, not what might happen tomorrow. His methodology became a system for identifying stocks that were under heavy institutional accumulation, evidenced by specific chart patterns, and then buying them at the precise moment that accumulation transitioned into explosive breakouts. He wasn't trying to outsmart the market. He was trying to follow the smart money to ride their coattails as they drove prices higher. The patterns he focused on weren't secret or proprietary formations. They were classic chart patterns that had been studied by technical analysts for over a century. Patterns like flat bases, ascending triangles, flags, and pennants. These formations have been documented in trading literature since the early 1900s. But Zanger's genius wasn't in discovering new patterns. It was in achieving absolute mastery of the existing ones. He developed an almost photographic ability to recognize high probability setups. Where other traders saw random price movements, he saw clear visual representations of supply and demand dynamics. Where others saw chaos, he saw order. This level of pattern recognition can only be achieved through obsessive repetition, through studying thousands upon thousands of examples until the patterns become as recognizable as familiar faces. But here's the psychological trap that catches most traders. They learn about these patterns, they study a few examples, and they think they're ready to trade. They don't realize that true mastery requires years of dedicated study. They don't understand that the difference between amateur pattern recognition and professional level expertise is measured in decades, not days. Zanger's approach to market psychology also involved understanding the emotional cycles that drive price movements. He knew that after a stock made a strong advance, it would need to pause and consolidate before making its next move higher. These consolidation periods weren't signs of weakness. They were signs of health. Evidence that the stock was digesting its gains and preparing for the next leg up. During these consolidation phases, he could see the psychological battle playing out on the chart. Early investors taking profits, creating supply. New buyers stepping in, providing demand. The stock would trade sideways as shares transferred from weaker hands to stronger hands. From short-term traders to long-term institutional investors. The key psychological insight was recognizing when this consolidation process was complete. When the selling pressure had been absorbed and the buyers were ready to push prices to new highs. This transition point, marked by explosive volume and a decisive break above the consolidation range, was where Zanger struck with precision and force. Here's a brutal reality check that's about to sting. Think about your last 5 losing trades. How many of them were you trying to catch the knife on a falling stock versus waiting for that explosive breakout volume? If you're honest, at least 4 of those losses came from buying weakness instead of strength. Double tap this video if that just hit you like a brick, and drop guilty in the comments if you're ready to admit you've been doing this backwards. The psychological foundation of Zanger's success wasn't just about recognizing patterns. It was about developing the mental fortitude to act on them when the moment was right. Most traders suffer from analysis paralysis. They see the setup, they understand the pattern, but when it comes time to pull the trigger, they hesitate. They second guess themselves. They wait for more confirmation, more signals, more certainty. But here's the brutal truth about market psychology that Wall Street doesn't want you to understand. Certainty is the enemy of profit. By the time you feel completely certain about a trade, the opportunity has already passed. The biggest moves happen when most people are still doubting, still waiting, still hoping for a clearer signal that will never come. Zanger understood this psychological paradox. He knew that the best trading opportunities feel uncomfortable. They happen when your rational mind is screaming that you're making a mistake, when every fiber of your being wants you to wait just a little longer for more confirmation. The market rewards those who can act decisively in the face of uncertainty, not those who wait for guaranteed outcomes. This is why his screening process was so ruthless. He wasn't looking for good companies or safe investments. He was hunting for what he called rockets, stocks with the potential for explosive, near vertical price moves. His criteria formed a brutal filter that eliminated 99% of all available stocks, leaving only the most volatile, momentum-driven leaders in powerful bull markets. The fundamental side of his screening focused on companies with explosive business growth. He demanded quarterly earnings increases of at least 30 to 40% year over year. But his greatest winners often showed earnings growth of 100, 200, or even 300%. This wasn't about finding steady, reliable companies. This was about identifying businesses that were experiencing exponential acceleration. He also insisted on seeing corresponding revenue growth of at least 25%. This confirmed that the earnings weren't just accounting tricks or one-time cost cuts. The companies had to be genuinely expanding their business at breakneck speed. But earnings growth alone wasn't enough. He needed a compelling story, a reason for the explosive growth, a revolutionary product, groundbreaking technology, or a business model that was disrupting entire industries. The psychological element here is crucial. Stories capture imagination. They create the narrative that drives institutional buying and public fascination. During his legendary run in the late 90s, he focused on internet, technology, and telecommunications companies that weren't just growing. They were creating entirely new industries before the world's eyes. Once the stock passed his fundamental filters, the technical screens became even more demanding. He only wanted the market's absolute leaders, stocks that were outperforming 95 to 99% of the entire market. This isn't about finding hidden gems or undervalued opportunities. This is about riding the strongest horses in the race. Most traders fear volatility. They see big daily price swings as dangerous and unpredictable. But Zanger actively sought out high volatility stocks. He understood that stocks capable of moving 5 to 10% in a single day were the ones with potential for massive quick gains. Volatility wasn't his enemy. It was his profit engine. The final screen was the chart pattern itself. A stock could have explosive earnings growth, a compelling story, and market-leading momentum. But without the right technical setup, without one of his classic patterns forming at the right time, he wouldn't touch it. The pattern was his final confirmation that institutional money was positioning for the next major move. This brings us to the execution phase, where psychology becomes everything. Zanger's entry technique was deceptively simple. He bought stocks at the precise moment they broke out of their consolidation patterns. But the simplicity is misleading. The psychological pressure of executing this strategy is enormous. When a stock breaks out, it's already moving higher. Your rational mind tells you that you're buying at a high price, that you should wait for a pullback, that you're chasing the move. Every instinct screams that you're making a mistake. This is where most traders fail. They see the breakout happening, they understand it's the signal they've been waiting for, but they can't bring themselves to buy a stock that's already up several percent for the day. Zanger understood that this psychological resistance is exactly why the strategy works. The majority of traders are hardwired to buy low and sell high. They want to catch the bottom and ride the entire move. But this approach ignores the fundamental psychology of how big moves actually develop. The biggest price advances don't start from bottoms. They start from breakouts above previous resistance levels. The volume confirmation was non-negotiable. He demanded that breakout volume be at least 50% above the stock's average and ideally several 100% higher. This explosive volume was proof that institutions weren't just nibbling around the edges. They were committing serious capital, pushing the stock higher with overwhelming force. A breakout on light volume was a false signal that he would ignore completely. This psychological discipline separated him from amateur traders who chase any upward movement regardless of volume. The volume told a real story about institutional commitment. Without it, the breakout was just noise. But here's where his psychological framework becomes truly revolutionary. His stop loss discipline wasn't just about limiting losses, it was about preserving mental capital, maintaining the psychological edge necessary for aggressive speculation. He would never let a stock fall more than 3 to 5% from its breakout point. Period. No exceptions, no hoping for recovery, no waiting for better news. This iron discipline was the key that unlocked his entire aggressive approach. It allowed him to use leverage, to concentrate his capital in just a few positions, to take the kind of risk that most traders would never consider. Because he knew that any single loss was mathematically contained, he could afford to be psychologically aggressive on the upside. Most traders approach risk management backwards. They're conservative with their winners and aggressive with their losers. They sell their profits too early and hold their losses too long. Zanger flipped this completely. He was aggressive with his winners, often adding to positions that were working, and ruthlessly conservative with his losers, cutting them immediately when they didn't perform as expected. The psychological challenge of this approach cannot be overstated. It requires you to act against every natural human instinct about loss aversion and profit taking. It demands that you embrace discomfort, uncertainty, and the constant possibility of being wrong. But for those who can master this psychological framework, the rewards can be extraordinary. This psychological framework became the foundation for what happened next. In mid-1998, with just under $11,000 in his account, Zanger began applying his methodology with surgical precision during one of the most explosive bull markets in history. But here's what most people miss about his legendary run. It wasn't luck. It wasn't timing. It was the culmination of 2 decades of psychological conditioning that allowed him to see opportunities where others saw chaos. The dot-com era created the perfect environment for his approach. Technology companies were exploding with growth rates that had never been seen before. The internet was transforming entire industries overnight. But while everyone else was getting caught up in the story, the hype, the promise of revolutionary change, Zanger remained focused on what the charts were telling him. He let the patterns guide his decisions, not the emotions of the crowd. His portfolio during this period reads like a hall of fame of internet winners. Yahoo, which formed a perfect flat-based consolidation before launching into orbit. Qualcomm, a mobile technology pioneer that went on a near vertical parabolic run that defied gravity. America Online, the internet service provider that connected millions to the web for the first time. Each of these stocks exhibited the exact psychological and technical characteristics he had spent decades learning to identify. But here's the part that separates Zanger from every other trader who got lucky during the bubble. He wasn't just buying and hoping. He was managing each position with military precision. When a stock broke out and immediately started working in his favor, he would often sell a portion of his position into the initial strength. This locked in quick profits and reduced his risk exposure while keeping his core position for the bigger move. The psychological benefit of this approach is profound. By taking some profits early, he removed the emotional pressure from the trade. He was now playing with house money, which allowed him to hold the remainder of his position with a clear mind. Most traders do the exact opposite. They hold their entire position, watching paper profits come and go, until eventually fear forces them to sell at the worst possible moment. For positions that continue to work, Zanger used trailing stops based on short-term moving averages. He would ride the trend as long as it remained healthy, but the moment the stock showed signs of institutional selling, he was gone. This wasn't about being right or wrong. This was about following the flow of smart money and getting out when that flow reversed. The leverage component of his strategy is where the psychology becomes truly dangerous for most traders. Standard margin allows you to control twice as much stock as your account value would normally permit. This amplifies both gains and losses by the same factor. A 10% gain becomes a 20% gain, but a 10% loss also becomes a 20% loss. Most traders who attempt to use leverage fail catastrophically because they don't understand the psychological pressure it creates. When you're leveraged, every small movement against your position feels magnified. Your emotions become heightened. Your decision-making becomes clouded by fear and greed. The very tool that's supposed to accelerate your profits ends up destroying your ability to think clearly. Zanger's system worked with leverage precisely because of his stop-loss discipline. His maximum allowable loss of 3 to 5% on any position meant that even with leverage, his account drawdowns remained manageable. A 5% loss on a leveraged position translated to roughly a 10% account loss, which was painful but not devastating. This mathematical relationship allowed him to use leverage as a tool for growth rather than a weapon of self-destruction. The psychological insight here is crucial. Leverage without discipline is suicide. But discipline without leverage limits your potential for explosive returns. The combination of aggressive position sizing with conservative loss limits created the perfect mathematical framework for compound growth. Small controlled losses combined with large leveraged winners created the asymmetric return profile that drove his extraordinary results. By the end of 1999, after just over a year of applying this methodology, his account had grown from under $11,000 to $18 million. This wasn't the result of one lucky trade or a single home run stock. This was the outcome of hundreds of disciplined executions, each following the same psychological and technical framework he had developed over decades of study. The key psychological element that allowed this level of performance was his complete detachment from individual trade outcomes. Most traders become emotionally invested in being right about each position. They turn trades into personal battles against the market. When a stock goes against them, it becomes an attack on their intelligence, their analysis, their self-worth. This emotional attachment clouds judgment and leads to poor decisions. Zanger approached each trade as nothing more than a probability play. He knew that his edge came from playing favorable odds repeatedly over time, not from being right about any single position. This psychological framework allowed him to cut losses quickly, without ego involvement, and ride winners without the fear of giving back profits. The continuation of his run into early 2000, growing his account to a reported $42 million, demonstrated something profound about market psychology. Success in trading isn't about finding the perfect system or the secret indicator. It's about developing the mental framework to execute a proven methodology with absolute consistency, regardless of market conditions or emotional pressure. But here's where the story takes a turn that reveals the most important psychological lesson of all. The same bull market that created Zanger's fortune eventually turned into one of the most devastating bear markets in history. The dot-com crash wiped out trillions in market value and destroyed countless trading accounts. The very stocks that had made fortunes for momentum traders became wealth destroyers of epic proportions. And this is where the story gets dark, and most trading gurus conveniently leave this part out. The dot-com crash didn't just hurt, it obliterated accounts. Even legendary traders gave back fortunes. If you think you can handle the win, but you're not prepared for what happens when the music stops, you're about to get schooled. Subscribe and hit that bell if you want the full truth about market cycles and how to protect your gains when everyone else is getting destroyed. This is where the psychological rubber meets the road. Having the discipline to build wealth during favorable conditions is one challenge. Having the wisdom to preserve that wealth when conditions change is an entirely different test. The market gives and the market takes away. The only constant is change, and successful traders must adapt their psychology to match evolving conditions. The lesson isn't that Zanger's methodology was flawed or that momentum trading doesn't work. The lesson is that every strategy has its season, and the psychological flexibility to recognize when conditions have changed is just as important as the discipline to execute during favorable periods. The market is always testing your psychological edges, always probing for weaknesses in your mental framework. What makes Zanger's achievement so remarkable isn't just the magnitude of the returns, but the psychological mastery required to execute such an aggressive strategy without self-destructing, the ability to use maximum leverage while maintaining perfect discipline, the mental toughness to cut losses immediately while letting winners run to their full potential, the emotional detachment to treat each trade as just another probability play in an endless series of opportunities. This brings us to the broader implications of his success for anyone trying to build wealth in the markets. The traditional investment industry promotes the psychology of mediocrity. They want you to accept average returns, to diversify away your potential for greatness, to be satisfied with slow, steady progress that barely keeps pace with inflation. They sell you the illusion of safety while quietly extracting fees that compound against you over decades. Zanger's story proves that extraordinary returns are possible for those willing to develop the psychological framework necessary to capture them. It's not about having special access or secret information. It's about having the mental discipline to recognize opportunity when it presents itself and the courage to act decisively when others are paralyzed by uncertainty. The patterns he used are still visible in today's markets. The psychological dynamics that drive institutional accumulation and explosive breakouts haven't changed. Human nature remains constant, and the visual language of supply and demand continues to reveal itself through price and volume action. The opportunities for explosive growth still exist for those with the psychological tools to recognize and capture them, but this requires a fundamental shift in how you think about risk and reward. Most people are programmed to avoid volatility, to seek certainty, to play it safe. This psychological conditioning virtually guarantees mediocre results because the biggest opportunities always involve uncertainty and discomfort. The market rewards those who can embrace volatility as a tool rather than fear it as a threat. The screening criteria Zanger used to identify potential rockets can still be applied today. Companies with explosive earnings growth, compelling business stories, and strong technical momentum still exist in every bull market cycle. The challenge isn't finding these opportunities. The challenge is having the psychological framework to act on them when they appear. This means developing the mental discipline to focus on a small number of high probability setups rather than trying to trade everything that moves. It means having the patience to wait for perfect conditions rather than forcing trades when the setup isn't ideal. It means having the courage to act aggressively when all the pieces align, even when your rational mind is screaming that you're taking too much risk. Here's what I need from you right now. What's the one psychological barrier that's been destroying your trading results? Is it buying weakness instead of strength? Holding losers too long? Taking profits too early? Not using stops? Whatever it is, comment below and own it. No excuses, no blame, just brutal honesty. Because until you admit what's broken, you can't fix it. And if this story is making you realize you need to completely rewire your trading psychology, smash that like button. The execution psychology remains the most challenging aspect. Buying breakouts feels wrong because you're purchasing stocks that are already moving higher. Your brain is wired to want bargains, to buy low and sell high, to catch bottoms and tops. But the biggest moves don't start from bottoms. They start from breakouts above resistance, when institutional money is pushing prices into uncharted territory. The volume confirmation aspect is crucial because it reveals the psychological commitment of smart money. When institutions decide to accumulate a position, they can't hide their buying pressure. It shows up as explosive volume that's impossible to fake or manufacture. Learning to read this institutional footprint is like having X-ray vision into the market's true intentions. The stop-loss discipline remains the most important psychological skill any aggressive trader can develop. It's not just about limiting financial losses. It's about preserving the mental capital necessary for the next opportunity. Every dollar you lose to a bad trade is a dollar that can't compound into future wealth. But more importantly, every large loss damages your psychological confidence and makes it harder to pull the trigger on the next high probability setup. This is why the 3 to 5% maximum loss rule is so powerful. It ensures that no single trade can create significant psychological damage. It allows you to approach each new opportunity with a clear mind, unburdened by the emotional baggage of previous failures. This psychological clean slate is essential for maintaining the aggressive mindset necessary for explosive returns. The profit-taking psychology is equally important but more nuanced. Taking partial profits early serves two purposes. It locks in gains that can't be taken away by market volatility, and it reduces the emotional pressure on the remaining position. When you're playing with the house money, you can hold for bigger moves without the constant fear of giving back everything you've gained. But the core psychology that drives everything is the understanding that trading is ultimately about following institutional money flow. Retail traders move prices in minutes or hours. Institutional money moves prices over weeks, months, and years. Learning to identify when smart money is accumulating positions before the general public catches on is the key to capturing explosive moves before they become obvious to everyone else. This requires a shift from trying to predict what will happen to simply recognizing what is happening right now. The chart tells you everything you need to know about current supply and demand dynamics. It reveals when selling pressure is being absorbed, when accumulation is occurring, and when breakouts are ready to launch. You don't need to know why these things are happening. You just need to recognize that they are happening and position yourself accordingly. The psychological framework that enabled Zanger's success reveals something profound about how wealth is actually created in the markets. Most people approach trading with the mindset of a consumer, looking for the cheapest entry point, hoping to catch a bargain. But institutional money thinks like a predator. They're not hunting for bargains. They're hunting for momentum, for stocks that can deliver explosive returns in compressed time frames. This creates a fundamental disconnect between retail psychology and professional psychology. Retail traders want to buy low and sell high. They want to catch the bottom and ride the entire move. This sounds logical in theory, but it ignores the brutal reality of how major price advances actually develop. The biggest moves don't start from support levels, they start from breakouts, when stocks are already moving higher, when most people think they've missed the opportunity. The psychological challenge is enormous. When you see a stock breaking out to new highs, every instinct tells you it's too late. Your brain calculates how gained and assumes the easy much the stock has already money has been made. But this thinking is backwards. Breakouts to new highs are often the beginning of the real move, not the end. They're the moment when institutional accumulation transitions into aggressive buying, when the smart money stops being patient and starts being urgent. Understanding this psychological shift is crucial because it explains why most traders fail to capture explosive moves. They're waiting for pullbacks that never come. They're hoping for second chances at lower prices while the stock continues climbing without them. By the time they finally give in and buy, the move is often exhausted and ready to reverse. Zanger's edge was recognizing that in powerful momentum stocks, the best entry point isn't the lowest price. It's the moment of institutional commitment revealed through explosive volume and decisive price action above resistance. This requires a complete rewiring of your trading psychology, abandoning the consumer mindset in favor of the predator mindset. The screening process he used reveals another psychological truth about successful trading. Most people want to trade everything. They see opportunity in every stock, every sector, every market condition. But this scattered approach dilutes focus and reduces effectiveness. Zanger understood that specialization creates expertise and expertise creates edge. His brutal filtering process eliminated 99% of available stocks, leaving only the most explosive growth stories with perfect technical setups. This wasn't about missing opportunities. This was about concentrating firepower where it could do the most damage. By focusing exclusively on momentum leaders breaking out of consolidation patterns, he stacked every possible advantage in his favor. The psychological discipline required for this approach cannot be understated. You have to resist the temptation to trade marginal setups. You have to watch hundreds of stocks move without you because they don't meet your criteria. You have to maintain laser focus on your specific edge while the market tempts you with countless distractions. This brings us to perhaps the most important psychological insight from Zanger's methodology. Success in aggressive speculation isn't about being right more often than you're wrong. It's about making your winners so much bigger than your losers that you can afford to be wrong frequently and still compound wealth at extraordinary rates. His system was designed around this mathematical reality. Small, quick losses combined with large, leveraged winners created an asymmetric return profile that could generate explosive results even with a relatively modest win rate. But executing this approach requires psychological courage that most people simply don't possess. Listen, Dan Zanger turned $11,000 into $42 million because he developed a psychological framework to execute a proven methodology with absolute discipline. The patterns are still there. The opportunities still exist. The only question is whether you're going to keep making the same psychological mistakes that keep you broke, or if you're ready to rewire your brain for wealth. If you want to learn the exact psychological frameworks that separate the 1% from the 99%, click the video that just appeared on your screen. And if you're finally ready to stop being your own worst enemy in the markets, subscribe and ring that bell, because your trading psychology is either your greatest weapon or your biggest weakness. Choose wisely,